Hello, can you hear me? Hello, can you hear me? Hello, can you hear me? All right. Thank you so much, guys, for some of you who were patient enough to wait until I was able to fix this. Yeah, I really had an issue trying to fix the audio, but I think we are good now. Hello, can you hear me? You can comment, right? Hello, can you hear me? All right. Thank you so much, guys, for. So I'm quickly going to run through with us in the few minutes that we have now. We're not going to take a lot of time. This is our first YouTube live stream where I will be sharing with you my approach to the market in this stream called Forex Strategy Session. Okay, so it's literally going to be something that it's going to come up every single week, hopefully every weekend, Saturdays specifically, and then subsequently we see how I really want to help developing traders find the missing link in what they are doing and be able to come into profitability in the financial market industry, specifically Forex. And those of you trading other asset classes, okay, like bonds, commodities, equities, whatever it is. Okay, guys, yeah, I'm trying to share the links with the other communities who have been anticipating that we were going to commence this live program. So that's what I just did now. Okay, so kindly exercise patience, just a few minutes and I'll be done sharing with these communities and we get started. Yeah, if you are hearing me, I'd like you to just type something in the comment section. Let me know that you are with us and you really are getting what I'm communicating. Just type in the comment section. I hope that the comment section is opened for comments. So just type in the comment section, or you can just like the video as well. Let me know that yes, you're hearing me right now. So sorry for the delays we had to experience. Okay, yeah, like I explained, it was a technical error. I didn't see it coming. Okay, guys. This is the first time I'm using OBS to live stream and as well get to share my screen. The purpose of this live stream is to be able to share my screen with you guys so that you get to see what I'm doing, because the purpose is to share with you my approach to trading and how I look at the markets on a weekly to daily basics, right? Okay, so okay, somebody is saying that my chat is being disabled. We're patient enough to wait until I was able to fix this. Yeah, I really had an issue. All right, so some of you who have access to me, thank you so much for joining. I know that quite a lot of my private and personal students are on this live stream and are also watching. So just in case there be any time you are not hearing me or my audio gets to go off, just put up a call. I will get to see it, or send me a message on my WhatsApp DM, so that I'll be sure we're doing the right thing, okay, and that this is going smooth as expected. So quickly, I would like to take a recap, or just to orient the beginner trader who doesn't have so much knowledge regarding how to trade and what price entails every time the market is printing out institutional signatures. Okay, personally I'm an ICT trader and I trade smart money concept, okay, specifically the ICT concept. Okay, so but I've been around in the industry. I've learned so many things. A lot of traders are getting to learn now and are struggling with it, okay, because trading is in different stages. You would first start with the struggling stage, where you get to learn, take many courses that are not even relevant to your development in trading, but you never really get to know until you truly get to find the right concept, okay, and you start to see profitability in the market. Okay, so thank you so much, Shaun. I can see your comments that you can hear me clearly now, right? So I just want to give you a brief introduction to what price delivery is and what price does every time you come to the chart. There are only 4 elements to a trade setup, okay. Those of you who are ICT students will have an idea on what I'm talking, and it even makes sense that you have an idea, because what I'm trying to share is going to be more beneficial to those of you who have been trading smart money, or you've learned ICT concept, okay, or you previously have an idea of price action. This is going to be in series. I obviously cannot dish out everything on one series because it's going to take us a lot of time, okay. I don't intend to spend more than 30 to 40 minutes, at worst 1 hour on this session, okay, with everyone. But I truly believe that it's going to be very educative. Okay, so there are only 4 elements to a trade setup. The first is that price is either in an area of consolidation. Let me do this so that you get to see what I'm doing. Okay, price is either in an area of consolidation, or price is either in an expansion, or price is retracing or in a retracement, and lastly price is in a reversal. These are the only 4 elements of a trade setup. In any asset class that you come across, this is how to look at price, okay. So every time I come to the charts, basically I need to know where we are currently, okay. I need to know where price has traded from. Has price traded from an area of consolidation? And then I need to identify where we are currently. Are we in an area of expansion, or are we in a retracement? If we are in a retracement, what are the institutions trying to look for in every retracement that you see? There are specific institutional reference points that the market makers are looking for every time they are repricing an asset class or a currency pair. There's something they are looking for. They are not just retracing. They are retracing because there's something they are looking for. Then the last is, are we in a reversal? Has the trend ended? Okay, once we are in a reversal, you know that, okay, this trend, either it's a bullish trend or a bearish trend, has obviously ended, and you start to see smart money engineer signature for the new trend, either to shift from a bearish trend and start to go bullish, or to shift from a bullish trend and start to go bearish to the downside. That's what I mean. Okay guys, so I need to know where price has traded from. That's the first thing I do once I come to the chart. I need to know where price has traded away from, using these 4 elements of a price of a trade setup, okay. Has price traded from a region of consolidation? Has price traded away from an expansion? Has price traded from a retracement level? And if that's the case, where is it heading to? Has price traded away from a level of reversal? This is the first thing I want to know. Okay, where has price traded from? Where has price previously traded from? That's the first thing we need to know. Secondly, and how to identify that is by looking at price delivery. Where has price traded away from? Has it traded from a region of consolidation, expansion, retracement, or reversal? Then we need to know where price is currently. We need to know where price is currently. Okay? These are the two things I need to know first. All right? Then what's the third thing I need to know? Then the third thing is to identify institutional order flow. Institutional order flow of the higher time frames. Okay? Because the higher time frames are the main drivers of price action. Okay? The higher time frames is the main draw on liquidity. That's where the institutions and the smart money position themselves. They are not in 1 minute time frame. They are not in 5 minutes. They are not in 15 minutes, 1 hour time frame. The smart money and the institutions or the market makers base themselves on the monthly, weekly, and daily time frame. And that is why most of the times, those of you trading smart money concept, especially those of you trading just structure and breaking market structure, you'll notice that a lot of times you would see a structure, for example, for a bearish sell, okay, only for you to execute and price violates that bearish structure and goes bullish. Or you'd see a structure that tells you we are going bullish, a bullish breaking market structure, only for you to execute and price goes bearish. Why is it so? The reason is because you are not in tandem with the higher time frame institutional order flow. The higher time frame will always overrule the lower time frames, okay? And the lower time frames will always align themselves with what the higher time frames are saying. So if the higher time frame is saying that we are in a bullish retracement, you have no business trying to sell on the lower time frame. You should rather try to position yourself to buy that bullish retracement or that bullish trend of the higher time frame. If the higher time frame is saying we are in a bearish order flow or in a bearish trend, you have no business trying to buy on the lower time frames, okay? Or even if you were buying on the lower time frames, you already have an idea that what you are doing is you are either buying a retracement because we are in a bearish institutional order flow. Okay? We are in a bearish institutional order flow. Okay? Because the higher time frame says we are bearish. So every time I come to the chart week in, week out, I need to know where we are, okay, relative to where price has traded from, and I need to know what the current institutional order flow is. On the weekly and daily, if I'm going to do day trading, because I do a lot of day trading, and because it's day trading, I will need to align myself with the weekly and daily time frames, with the weekly and daily institutional order flow. Once I know what the weekly and daily institutional order flow is, then I have the confidence to now go down to the 1 hour time frame to literally study where price is relative to where price has traded from again, and then I look for where the high probability setup is. Now, what's the last thing you need to do? So I said first, after you identify institutional order flow of the higher time frame, okay, after I'm done with this, I'm going to go to the chart and show you how I do that. Okay, so I said the third thing is identify institutional order flow of the higher time frame. Then the next would be, the next would be to go down to the 1 hour time frame, or identify two swing points on the don't worry, identify two liquidity pools, identify the most recent liquidity pool, okay, either residing above all highs, all those in form of buy stops. I'm really going to demystify these things, don't worry. Then the last thing is how we are going to enter, right? How to execute. These are the 5 things I look at. Okay, the first thing is where price has previously traded from, using price delivery concept, consolidation, expansion, retracement, reversal. Second is we need to know where price is currently. Are we in a retracement? Are we in an expansion? Are we in a reversal? Then the third is I need to identify institutional order flow of the higher time frame, then the current institutional order flow of the higher time frame, then I need to identify the most recent liquidity pool. Okay, so let me say this again. Liquidity resides in 2 forms. I hope that you really get to understand what I'm trying to share here. I said that liquidity resides in 2 forms. Liquidity resides either in a form of external range liquidity, okay, and liquidity residing in an external range are either old highs, okay, it's either above old highs or relative equal highs. Old highs, equal highs, or relative equal highs, okay. Above it resides buy side liquidity, okay. So you need to identify, I said, the 2 most recent liquidity pools, either above an old high, relative equal high, or equal highs. That type of liquidity is called an external range liquidity, okay. Then the next is that it also resides below old lows, equal lows, or relative equal lows. Relative equal lows. Okay, that kind of liquidity is called what? Sell side liquidity or sell stops. Okay, these 2 types of liquidity are called the external range liquidity. Then the other one is the internal range liquidity. Internal range liquidity. And the internal range liquidity resides either in form of fair value gap, okay, or other blocks, fair value gaps, or liquidity void, other blocks, okay. Basically, this is what internal range liquidity is. So these are the 2 types of liquidity you are looking for, because we are the concept I want to teach you for this day trading model is going to use the internal range liquidity as our entry signature, okay. So that's why it's necessary for you to understand it. We really may not be able to have a grasp of all of this on this one session, but even if we don't, in my next live stream I'll be able to we'll be able to continue from where we stop, and you will have a full grasp of what this is. So let's get started. All right, so consolidation is an area where we see price forming equal or relative highs and lows. Once you are in that situation, or once you're in that marketplace, okay, consolidation is something that looks like this. Price is forming relative equal highs or relative equal lows, okay. Once you see this, this is called consolidation, okay. It is called consolidation. So I need to identify this to see whether we are in this area. Okay, and usually after an area of consolidation, price will manipulate retail traders to go long if we are bearish, or to go short if we are bullish, and then they start to go down because we are bearish. So this first move to the opposite direction is actually called manipulation. Okay, they will manipulate retail. They will manipulate retail to go the opposite direction of the intended trend. Then we will see price create an impulse swing, which is our expansion. So this is expansion. Okay, this is consolidation. Now we are in an expansion. Okay, every expansion will create most times an inefficiency or liquidity void that the smart money or market makers will like to reprice into in a form of fair valuation. So the purpose of retracement is for fair valuation. Every time you see price retracing, it is actually retracing into specific fair value gaps in the chart. Okay, which of these fair value gaps should you pay attention to is that you will need to incorporate your Fibonacci levels so that you'll be able to identify premium and discount. What do I mean? This is what I mean. When you pick your Fibonacci between this high, just this recent expansion, to this low, for example, the institutions will prioritize most times the fair value gap above or at 50% of this range, or above 50% of this range. If we are bearish, if we are bullish, the institutions would like to go below 50% or at least trade into 50%. That's equilibrium. Okay, so you can see this is 0, this is 100, right? This is 50, 0.5 is 50%, and it is equilibrium. So if they are retracing, they would like to retrace into at least 50% or the fair value gap above 50%, which is premium. Another thing to take note of, okay, is that we will like to sell in a bearish market. We would like to sell at 50% or at premium markets. The premium market is when price retraced into or above 50% of the recently created range. Above 50% is premium, below 50% is discount. So we buy in a discount, we sell in a premium. I hope this is really clear. Okay, so we see this retracement. As price is retracing, identify the fair value gaps, okay, or liquidity void, okay, or the other block in or above 50% of the range, and that is called premium. So this is called retracement because we are bearish. Okay, this is consolidation. This is shifting market structure to the downside. This is retracement because this was the previous expansion. This is retracement. This is another expansion. This is retracement. This is expansion. Okay, and once you see a new shifting market structure, especially after the target has been reached, because once smart money trades into an external range, especially on the higher time frame, most times you would see a reversal being engineered. Okay, if price is selling, where is it selling into? It is selling into sell-side liquidity of the higher time frame. Okay, either residing below relative equal highs, relative equal lows, old lows, or what? Equal lows. That's where sell-side liquidity is residing. So once it is taken, for example, if this was a sell-side liquidity that was taken and we see a shift in market structure, this signature tells you that a reversal is being engineered. Okay, so I'm done explaining price delivery now, and I really hope that some of you really get to understand what this is. This is consolidation, this is expansion, this is retracement, this is expansion, this is retracement, this is reversal because price took our liquidity below and then we see a shift in market structure. Okay, this is smart money reversal. It's going to engineer reversals. All right, so once I look at the chart, I'm looking at the chart with this knowledge. On the higher time frame, for example, this is the dollar and this was the weekly time frame. Okay, now look at this. Price had been bullish all this time. Price was bullish, and where did price traded into? Price traded into a previous premium mitigation block that I really hope this is understood. So previously I was looking at price action trading into a mitigation block around this region, and also this sell side imbalance and a buy side inefficiency. Okay, please, if you want to truly get a clear picture of the things I mentioned, if you just go to the videos on the channel, you'd see that these things were already mentioned previously. I thought about these things. Okay, so I was looking at price trading into this level. Sorry, let me go to the monthly time frame. I think there would be more clarity. Yes, on the monthly time frame. So you can see that it's this mitigation block of the monthly time frame I was looking at, and also this sell side imbalance and the buy side inefficiency. Specifically, the difference between a mitigation block and a breaker block is that in a mitigation block, what forms a mitigation block is a failure swing. Okay, you can see failure swing. There's a failure swing first, then there's a shifting market structure or breaking market structure. Then what you have here is a bearish mitigation block. A bearish breaker is when you have a turtle soup or liquidity grab before the breaking market structure. Then this is a bearish breaker. This is the difference between a breaker and a mitigation block. Okay, so if you look at this, you'd see that there's a failure swing. There's a shifting market structure here, right? This last sell candle that was traded through, and the body of the candle closed below that low, gives us that mitigation block. Okay, the most valid mitigation block is the one that has a confluence of another block or fair value gap attached to it. So in this case, I identified a mitigation block that has a fair value gap attached to it, or you can call this sell side imbalance. Okay, or all of this is actually liquidity void, or you can call it sell side imbalance or buy side inefficiency. Price traded into it straight up on the monthly time frame. Immediately I saw this, I knew that okay, now we are at a premium institutional reference point. Why did I say we are in a premium? If you put your Fibonacci between this high to that low, this low here, let's do it this way, this low to that high, okay, you would notice that price traded above 50% and traded straight into about 79%. This is deep premium, and we want to be selling in a premium market. We sell in a premium market, we buy in a discount market. I hope this is very clear. Okay guys, so once this is identified on the higher time frame, remember I said we look at where price has traded from using price delivery, right? So where has price traded from? Price traded from a level of what? Look at this. Price traded from a level of what? Previous consolidation. Okay? Previous consolidation. Then expansion. Previous consolidation. Expansion. Okay, so price traded from a level of expansion into that institutional reference point. And then what is price doing currently? Price is retracing into this recently created range. What's that recently created range? This low to this high. Okay, we need to buy from a discount if we are bullish, okay, or we need to sell in a premium market. So this is the recently created range. So when we were here, we know that, all right, this is deep premium because price has also traded into the previous premium range. Once we now see a confirmatory signature on the weekly and daily time frame that confirms we are going to start selling, where are we selling into? We are going to sell into a discount, at least at 50% or below 50%. Excuse me. Before we start to buy, okay? Or if the institutional order flow has changed into a bearish market, we will still need to retrace into a premium market before we start to sell. That's how I look at price. So price consolidated, expanded. Now we were retracing. I think I was in all of this sell. I saw all of this sell. We started to short this thing about 4 months ago, right from around, is it November, December? Or was it even October, November, December? We were in all of these shorts. We saw all of this happening. Right from here, we started to look for shorts into this very region. And until price traded into this discount, we were interested in selling. And around this region, we started buying. We were buying the dollar in the last 4 weeks to 5 weeks. We were interested in buying the dollar. What was our basics for buying the dollar? It was because price has retraced into, what did I say price is going to retrace into? When the institutions are retracing, I said identify fair value gaps. Okay, below a discount market or below 50% if we are going to buy. Now look at this, 0, 100, this is 50%. Is there a fair value gap below it? Yes. Where is that fair value gap? Look at this. So that is the fair value gap I'm looking at. Why? Because price delivery says if we are retracing, we are actually retracing into fair value gaps for fair valuation or other blocks. All right, so you can see that this fair value gap confluences with a discount market below 50%. This is high probability for me. So once price trades into this and I start to see the institutions imprint a bullish signature, I'm interested in buying. All right, so what is institutional order flow? There is just a very easy trick I use for identifying or defining institutional order flow, especially on the higher time frame, because I said that the institutional order flow of the higher time frame is the main driver of liquidity. Okay, because once you know what the higher time frame is saying, you are in sync with smart money or the institutions. All right, so guys, a quick trick to identifying or defining higher time frame institutional order flow is that on a monthly time frame and in a bullish institutional order flow, we need to see the willingness of the monthly candles to constantly take out the highs or the previous monthly highs or the highs of the previous monthly candles. In a bullish institutional order flow, we need to see price constantly take out the highs of the previous monthly candle. So this was bullish all along. Why was it bullish? We started to see price had formed a bullish order block here, and from this bullish order block we see that the monthly time frame has been showing willingness to take out the highs of the previous monthly candle. This candle took out this previous high, this candle took out this previous high, okay, this candle took out this previous high, this candle took out this previous high, this candle took out this previous high, this candle took out the previous highs. You can see it is all about the highs and not the lows. Once you see this, man, you know that institutional order flow is bullish. And where is it heading to? It's heading into a region of what? Liquidity. Either internally as internal range or external as external range. So where is the internal range liquidity here? It will be fair value gap. Okay, it will be fair value gap right here. Fair value gap. Where is the external range liquidity there? It would be this old high. This old high is there. Okay, you can see that. So that is where liquidity is residing. By my left here is also internal range liquidity, which is fair value gap and liquidity void. This is where smart money traded into in a bullish institutional order flow. In a bearish institutional order flow, smart money will show willingness to take out the previous monthly lows of the monthly candles. Okay, so you would see that all through this time, you can see that we see that price has taken out this low. The next candle took out the low. The next candle took out the low. In the last 4 months, 1, 2, 3, 4 months, we had a bearish institutional order flow, because the monthly candles has been taking out previous monthly lows. All right, now we see that the monthly candle has taken out the previous monthly high. About two highs has been taken out. I'll be paying attention to the dollar going to the upside, except that the dollar may also, the dollar should trade into a level of internal range liquidity here, which is what? Sell side imbalance and a buy side inefficiency, or fair value gap. You can just call it fair value gap for simple identification. The low here to the high here, this gap in between is called fair value gap. There's something here I wouldn't like to mention now because some of you may really get confused, and this is not the goal for this training, right? This is our first episode, I told you. So that's how to identify institutional order flow. Okay, just identify on the monthly time frame, what is price doing, what has price done previously, what has price traded into. Okay, first is where has price traded away from, where has price traded into, where is price currently. That is current institutional order flow, right? Is price showing willingness to take out previous monthly highs or previous monthly lows? And this next thing I said you should do is what? Identify liquidity, right? So is price showing willingness to take out the monthly highs? If that's the case, identify the next buy side liquidity that has not been traded into, either as internal range or external range. Okay, if we are bearish because the monthly candles and the weekly candles has been showing willingness to take out previous monthly and weekly lows, identify the next sell side liquidity that has not been traded into, either in form of internal range, which is fair value gaps, right, other blocks, or external range in form of sell side liquidity residing below old lows, equal lows, or relative equal lows. That's where the institutions are going to head for, because that is what is going to be the draw on liquidity. The draw on liquidity. Okay, so prior to this time, at around this time, we were looking at, okay, I think this time, sorry. At around this time, I hope this my replay button works. Yeah. At around this time, we were looking at selling this asset, which is the dollar, into this discount fair value gap, because that's the next obvious internal range liquidity that the institutions will reprice into. The concept of repricing is that anytime price is in a premium, the institutions will reprice into a discount to collect more liquidity and distribute to external range liquidity. Okay, the way price functions, or the way price moves, is that price moves from an internal range liquidity, picks up orders from an internal range and delivers it into external range, or price moves from an external range and reprices into internal range. From an internal range, price will pick up orders and deliver or distribute into either buy side liquidity in a bullish market trend or sell side liquidity in a bearish market trend. Okay, once sell side liquidity is taken, the institutions would like to reprice into internal range for what? Fair valuation. Fair valuation. You are interested in seeing the fair value gaps at the premium or in the discount market structure. All right, so at this point, we are looking at selling into this fair value gap. All right, let's go to the weekly time frame. So now we know that we had a bearish institutional order flow. All right, now look at this. 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 Price traded into that our monthly mitigation block, and we have another failure swing and shift in market structure. Shift in market structure. Okay, so now that you're on the weekly time frame, you would like to identify what the current market structure is. Okay, this is the only time I'm interested in structure, when I know or have an idea of the other flow of the higher time frame. All right, so price traded into that region, price created a failure swing. The inability of price to take out this high tells you that we would start to see a sell signature. Okay, as at this time, when I compared this with foreign currency, I think I identified the smart money divergence. Subsequently, I will get to teach how to use smart money divergence in your trading. So here we have a shift in market structure, and if you study price action, you will notice that price has been showing willingness to take out the previous weekly lows. These lows were taken, this low was taken down. Okay, this was a retracement into the other block, 50% of this other block here. All right, and then you see again these two lows were taken. At this point, you just know that price is what? Bearish. Institutional order flow is bearish. But where is it heading to? It's heading into the monthly discount fair value gap. Okay, and sell side liquidity residing below what level? This old low, that old low there. Okay, there is another relative equal lows here, the body of the candles. Okay, there is another fair value gap here, which is internal range liquidity. This was how I was looking at the market when this price action was forming. Okay, I was looking at the institutions trading into this this old low, sorry. Okay, this fair value gap, which is internal range liquidity, the sell side liquidity residing below that old low, and ultimately the fair value gap of the monthly time frame. That was what I was looking for. Now, I made mention of something. I said once price takes out external range, we would like to retrace into internal range. Okay, now I'd like you to look at this price action. What did price do? Price took out external range here. What's external range? Liquidity residing below an old low or relative equal lows. After this shift in market structure, okay, here took out this old low and this old low. So this is an external range liquidity that was taken out. Where are we looking to go short? We are looking to go short, remember I said, from an internal range liquidity. I hope I'm not really bugging with so many stuff. Okay, so how to execute is where we are now. How to execute, right? Because now we have identified where the most recent liquidity pool is. All right, which we said is this old low fair value gap as internal range liquidity, relative equal low, the body of the candle as sell side liquidity, the monthly fair value gap, discount fair value gap is also internal range liquidity. That's where the institutions are repricing, into. Okay, so we were looking to go short immediately after this price. All right, if this was where we were, where are we going to go short? We are going to go short from an internal range liquidity. What is internal range liquidity? Fair value gap, order block. All right, so is there an order block here? What's the internal range liquidity? You can see here it is fair value gap. What's that fair value gap? The liquidity residing inside this recently created gap. Okay, the low here to the high here, this is sell side imbalance and a buy side inefficiency. The institutions will reprice into this level, okay, and expand to the downside. So what are we going to do here? Price is going to retrace after expansion. What's the next thing I said? Retracement. So price is going to retrace into this level, okay, and as this is happening, you're also looking at this low also because of how the protocol for using PDRs. Smart money students, ICT students, I know you know what I'm saying. You understand what I'm trying to say, right? So, but literally we just want to sell from this internal range. So immediately price trades into this internal range. We'll go down to the daily or 1 hour time frame and look for how and show you how to enter. And again, we are going to enter from an internal range liquidity. This is a weekly time frame. Go to the daily. Let's see where price action was. So on the daily time frame, on the daily time frame, you can see that this was an expansion. Okay, this was an expansion. Price retraced into internal range, fair value gap. Let's measure this range and see what that range literally represents. Oh, sorry. So price created a range. Okay, we are looking to enter or short from a fair value gap of the weekly time frame as internal range liquidity. All right, so this is the previously created range. So once we say retracement, we like to short from that weekly fair value gap, and you are looking at the fair value gaps at 50% or above 50%, which is premium. So I will be paying attention to these fair value gaps. Literally, this is what I'll be doing. This one because this is close to 50%, and this also because this is in a premium market. There's a reason why this didn't trade into that premium fair value gap. It is because of something called institutional order flow entry drill signature. Okay, that's the reason why price didn't trade into that premium fair value gap. All right, so subsequently I will teach you how to identify that institutional order flow entry drill. All right, guys, so price traded into that fair value gap here on the daily time frame. How are we going to enter? We are going to enter from a 1 hour perspective. And if we are going to enter a short, where are we going to enter a short? And then where are we targeting? All right, so let me take this out or reduce this so you see how I identify this. Okay, so we are going to enter in an internal range. First is that immediately price trades into our point of interest, we will need to wait. If you refine this carefully, you'll see that this was a 1 hour fair value gap that the institutions repriced into on the daily time frame and coincides with the weekly fair value gap. All right, so this is 1 hour fair value gap here. You can see that institutions traded into it. This fair value gap here, they traded into it, they tapped into it, and look at what happened. Price took our liquidity residing above an old high, but the body of the candle failed to close above it. We saw a rejection candle, price rejected and went into the range. This is signifying a heavy bearish pressure. Okay, then we see a shift in market structure. We see a shift in market structure. This is breaking market structure because the body of the candle has closed below. At the same time, this is a grasp on external range liquidity. Liquidity residing below, which is liquidity residing below, liquidity residing below an old low. In that case, below an old low, we said is external range liquidity. Okay, is external range liquidity. Sorry guys, let me reduce this to, so this is an external range liquidity. This is an external range. This is an external range liquidity. Liquidity residing below an old low. All right, so where are we going to execute? We are going to execute from an internal range perspective. You just patiently wait for the 1 hour time frame to create an external range, take out liquidity residing below an external range and create an internal range, and you will start shorting from an internal range. What's the internal range? Fair value gaps, order blocks. As simple as that is. So if you take a look at this price action, you'd see that we have something very, very interesting here. This is also a type of gap, okay? A type of fair value gap called vacuum block or vacuum gap. Okay, this is a vacuum gap. This is just a gap. This gap is also a type of fair value. This is the internal range we like to be shorting from. Also because when you use your Fibonacci, Just use your Fibonacci from that high to that low, okay, and pay attention to where price is trading into. So you can see that price is almost 50% of this entire range, okay. So, and this is the only fair value gap you can see there. It's the only fair value gap you have here. So this is where I'll be paying attention to go short. This is where I would be paying attention to start going short. Let me mark it out clearly. Okay, from that low to that high, that's the gap. All right, there is no point trying to rush or chase price if you patiently wait for price to tell you or show you the signature of where they want to go to. You have no fear whatsoever because you patiently waited. So immediately price trades into this level, I will go short here. I like to go short here with my stop loss above this high, okay, if I want to swing trade. Or you can go down to the 15 minutes time frame or 5 minutes time frame to look for confirmatory entry, just so that you can refine your SL and have a tiny SL. So where are you going to take profit? I'm taking profit at sell side liquidity. Where is the sell side liquidity here? This is the first sell side liquidity. Liquidity residing below an old low. Liquidity residing below what? An old low. You can see that. If you are taking this trade and waited, look at what happened. Price traded into it. Price tapped into it by 1 pip, and that's it. You are done with this trade. Price created another internal range liquidity here. All of this was what price traded into. Fair value gap and order block, internal range. But you must have had another reason, okay. I just had to cut just to use this as our example. All right, guys, so this is how I'm looking at entering the market. Let me go to the 15 minutes time frame and see whether we can see we can have that price action, or 5 minutes time frame just for confirmatory entry. So on the 15 minutes time frame, I'm looking at entering at internal range liquidity again. Look at what price did. Price took our liquidity again. Price broke structure to the downside. Price created an internal range. What's that internal range? Fair value gap or order block. In this case, we see another block that has a fair value gap attached to it. That's the most valid order block. So I would like to go short at the low of the order block, bearish order block here, or at the high, at the low of at the high of that fair value gap there. That's where I would like to go short, okay. And my SL will be above this high. Literally, this is less than 10 pips. This is 9 pip SL. You can see that, right? This is 9 pip SL using confirmatory signature. Once I execute from an internal range, we are looking for the next external range liquidity of the 1 hour time frame, which was this, and all of this relative liquidity pool, okay. This is low resistance liquidity run. Once you see price action create sequential lows and highs, or highs, like one here, you have another one here, you have another one here. Some people call it diagonal liquidity, because if you use your trend line, this would serve as liquidity. We don't see this as trend line, we see this as liquidity. So institutions traded into that pool of liquidity residing below this low resistance liquidity run and this old low. All right, guys, so that's how I look at price action every week, every day, okay, and every now and then. I really hope that this session is quite insightful and educating. I would like you to take your time, watch this again and again for clarity and understanding, and if you have questions, drop them in the comment section of this video. And as well, you can take your time to study some of the videos on this channel on internal range liquidity, liquidity pools, some of the things I mentioned, institutional order flow, right, on this channel, market structure, right, on this channel, and come back to this video again and watch and see how I incorporate all of these things. So once I know the direction of the dollar, that's the only time I would like to start taking the opposite direction on foreign currencies, GBP USD. I just go to GBP USD and implement the opposite of what I've seen here on GBP USD, because that's the only currency pair I trade. All right, one of the easiest way to find consistency is to stick with not more than 1 or 2 pair at maximum. Okay, when you do that for a period of 1 or 2 years, you'd see that you are literally coming into maximum proficiency and efficiency in your trading, and you'll be able to see the level of well, what is it called now, consistency, that's going to encourage you to continue again and again. Until next time, I wish you good luck, good trading. Thank you. If you have questions, don't forget to drop them in the comment section. Drop them in the comment section, guys. All right, so we can call